IVM.
BQ Big Decisions, the BloombergQuint podcast that helps you make the right financial choices. You know, growing up, at least in my home, the only investment we ever heard about was bank deposits. I knew about recurring deposits and fixed deposits and little else. It wasn't until much later that I came across equity and then bonds. Now, if you've been following the news this week, you'll have heard that there's a new investment option that everyone's talking about. It's the Bharat Bond ETF. Thanks for listening in. This is BQ Big Decisions and I'm Alex Matthew. On today's podcast, we're going to be talking about this new investment option, its salient features, and whether or not it can be described as an alternative to fixed deposits as it is being marketed. Joining me on this conversation is Arvind Rao, SEBI-registered investment advisor and founder of Arvind Rao and Associates. Thanks so much for joining me, Arvind.
It's my pleasure, Alex.
Now, let's first talk about what this is about, the Bharat Bond ETF. It's essentially an exchange-traded fund that allows you to invest in public sector bonds.
That's right. In fact, I think I have to share with you that a couple of days back, I had one of my clients calling me pretty excited in the afternoon saying that there is a new bond issue that is hitting the markets.
Okay.
And, what do you think of it? Should I be investing in it?
Right.
Now, having known him for at least a decade now, his attitude and his liking for fixed income investments, where he's constantly looking for opportunities to get interest and that too if they are government issued instruments, he prefers them more.
Yeah.
So my first answer to his question was, sir, let me just remind you that this is not a bond issue, but it is actually an ETF issue, which is going to be traded via the market. And I could hear the dampening in his sound when he said, "Oh."
Okay.
I said, you know what, you're not going to get any interest payments out of this issue. And then he said, okay, then I don't think I'm interested in it. So for all the listeners of this podcast, I think Alex has started the features about this Bharat Bond on the right note by mentioning that it is an exchange traded fund, which means it's actually an assortment of bonds issued by different companies under one basket.
Okay.
And as the name suggests, it's Bharat Bond. So basically it is going to be different government companies that will form this basket. And that is what makes this whole ETF a unique proposition because till date, never before has the Indian market seen such kind of a basket being made available to investors. Definitely you've had a lot of public companies or PSUs as they're called coming out with singular issues.
Yes.
But imagine 12 of them making a team and saying that just give your money in one basket and you will actually hold bonds of all of us at one go is something that really makes this product interesting.
I just want to point out here that if anyone's unfamiliar with the term exchange traded fund, we've done a separate conversation on one, index funds, and two, we've done a separate conversation on index funds and ETFs and what they essentially mean, the difference between the two. So I would actually encourage you to go and listen to that as well. We've also had, Arvind, a separate conversation on bond funds, where we've spoken about the instrument that is the bond and the fact that it's essentially a debt paper that is issued either by a company or by the government.
Right.
And it's like any other debt instrument. It bears interest and you can sell it in the secondary market. And thereby you can essentially sell it either at a profit or at a loss. And it can change the ultimate returns that you get from that product.
That's right. So of the various bond issues, quite a few of them also get listed on the secondary markets. And that's when you have an option to exit out via the market instead of waiting to hold it till its maturity.
Let's talk about this Bharat Bond ETF though. It's open for subscription already. It opened on the 12th of December.
Yes.
And it will be available till Friday the 20th of December.
That's right.
How does one go about subscribing to it?
So let's also highlight at this point that this issue is being managed by the Edelweiss AMC.
Yes.
So this is as good as a new fund offer for now. So anybody who's interested to buy it has to go via making an application for the same via the demat accounts.
Okay.
Just like they would apply for an IPO. And it's only post allotment and listing that they can actually go about buying and selling via the exchange. In the same fashion, they buy and sell equity shares on an exchange.
Okay. Is there a face value that has been assigned in that? How does one determine how many units one can pick up?
The face value will be 10 rupees.
Okay.
And I think for the retail sector, or rather I should say the individuals sector, the upper limit for investment in this ETF has been prescribed at 2 lakhs.
Okay. So up to 2 lakhs you can buy in this new
fund offer. Yes.
And then subsequently you can add more?
Absolutely. I mean, then it's freely available on the market, and I mean, it's anybody's choice as to how much they can invest in it. However, when we say that, it's also said that people who want to invest 25 crores or more has to approach the AMC, because that's a whole different liquidity ball game.
Yes.
And one will have to go back to the AMC to help them invest this large sum.
Okay, let's talk about some of the salient features of this ETF. It's essentially, like you already mentioned, 12 companies that will be issuing bonds.
Right.
And these will all be PSU companies, and the bigger issuers, one would think, and they all have the same rating as the sovereign, which is a AAA rating, right? That's the highest available rating.
A AAA sovereign rating, yes. In fact, I think the timing of this ETF could not have been better, for the simple reason that over the last 6 months to 1 year, we have been hearing about a lot of defaults on debt.
Yeah.
And, many people lightly also say that nowadays the debt market has become more volatile than the equity markets.
That's been true, yes.
And in this whole play, what's happening is that people really don't know what kind of credit risk they should be taking in for their portfolios. Which invariably, I mean, let me give an analogy that whenever you hear some bank going the wrong way,
yes,
people always say that I think State Bank of India is the best because that's the government bank.
So there is a flight to safety.
There's a flight to safety, which also brings us to this issue that when you're hearing so many corporate houses and other institutions filing for bankruptcy and raising their hands, people feel that government company bonds will be the best because it definitely comes with the government's guarantee behind it. So, like we said, it's a team of 12 PSUs. To name a few, you have like the top rung names like Indian Oil Corporation or the National Highway Authorities, the Export-Import Bank, and so on. So, goes without saying that since it is government backed, the rating is
the
top, and anything else, credit risk should be the least of the worries for the investors. And
credit risk, of course, to talk a little bit more about it. And the reason why we're talking about it now more than we were before is because in September last year, you had the default by IL&FS, which essentially had this domino effect in the debt markets. I was actually just reading a report from Bloomberg that suggested now, and perhaps some of our more informed listeners will understand what I'm saying here, the premiums that are charged with regard to some of these debt issuances, at least for the higher rated corporates, is now finally coming down to levels that were seen before the IL&FS default. So there is some level of comfort that is creeping back into the market right now, but still the lower rated corporates are struggling to raise funds. So when we used to talk before the IL&FS crisis about credit risk funds, now we're talking about those in a more circumspect way, shall we say.
I will add to this by saying that maybe prior to this episode, people used to only talk about credit risk.
Yes.
And a lot of investors have now seen how it unfolds.
Yes.
To the extent of the fall in the NAV that some of these credit risk debt funds have also taken.
Yes.
Where overnight they find that the NAVs have dropped by sometimes anywhere between 5% to 10%.
Yeah.
And it hurts or it has been hurting the investors more because they never thought that debt funds could also give negative returns.
That is a big misnomer. I think
Yes.
when a lot of people invest in debt funds, they think that it works exactly like a fixed deposit and that their capital is protected in that sense.
Right.
But it is not the case necessarily. If there is a default, then you're losing your money.
Yes.
And that essentially is what it means when you're saying that you're exposing yourself to credit risk. When we're talking about this bond ETF, though, because of the fact that it has the sovereign backing, that is the backing of the government of India, one would think that the credit risk is much, much lower.
Yes, I mean it's actually the government risk that one is taking up.
Yeah, and one wouldn't think that the government of India would default.
It's the risk. I mean, it's the risk of the highest order.
Yeah.
So I mean,
or the lowest order. If that's
I should be saying the lowest order. Yeah.
Yes. All right. Let's talk about some of the other features. There are two maturities, Arvind, that are being offered. There's, I believe, 3 years and a couple of months, and there's 10 years and a couple of months.
That's
right. And those are essentially as simple as that. But why is it important to talk about these two maturities? There's the aspect, I think, to talk about with regard to interest rate risk. I understand that these are what is called targeted maturity products,
right?
Which essentially means that once you've subscribed, you hold it for 3 years and a couple of months and 10 years and a couple of months, whichever you choose.
Yes.
But I think the interesting part here is that because it's an exchange traded fund, you can choose to exit prematurely.
True.
Yeah.
True.
So in that sense, if you're holding to maturity, you don't have to worry about interest rate risk. But if you exit prematurely, you have to worry about interest rate risk.
It will be because in the short term, with the kind of interest rate movements that happen, when I say interest rate movements, I'm actually referring to the announcements that RBI makes in terms of the cuts in the repo rate every quarter.
Yes.
So this will have a bearing on the prices of these bonds in the short term.
Yes.
So to take an illustration, like somebody subscribes to this in the month of December this year, and in the month of March or April, when the next RBI meeting happens, and for argument's sake, let's say RBI actually increases the repo rate instead of decreasing. So that's going to have some effect on the bond market.
Yes.
And at that particular point in time, an investor who wishes to exit from this ETF via the exchange may face some hit because this being market linked or market driven, the whole change in the interest rate movement will have a direct impact on the bond prices, which will reflect in the ETF. And having said this, why it is referred to as a targeted maturity product is that for every investor who is willing to wait for the 3 years or the 10-year mark, need not lose sleep, because whatever is the promised or the indicated return profile here will continue to hold, but it's only if you hold it till maturity.
Yes.
If you want to exit out in between, then you're exposed to the market.
So essentially, and let's talk about those returns that could be expected, right? Let's break it down. On the 3 year, what is expected, and on the 10 year, what's expected?
On the 3 year, I think the expected return is hovering around 6.5 to 6.7%.
That's net of taxes.
This will be the gross return.
So gross return is 6.5 to 6.7. And for the 10 year, we're talking about
it's around
over 7.
7.5 to 7.6 is what is indicated.
Understood. We'll talk about the tax aspect in just a short while.
Yes.
I just want to point out this thumb rule that has helped me when I'm trying to understand the dynamics in the bond market. Very simply, there is an inverse relationship between price and yield.
Yes.
So if the interest rates rise, or in a scenario where interest rates are keeping on rising, and assume that you're holding a bond, what will happen is essentially the price of that bond in a rising interest rate scenario will fall. So the price falls when the yield rises, and the price rises when the yield falls.
Just to add one bit to this, it also depends, the movement of the price movement of the bond will depend upon what is its current interest rate. So let's take this same Bharat Bond ETF example. So if the 3 year variant average yield is around 6.6,
yes,
and I think the repo today stands at anywhere close to 5.2 or something.
Yeah, thereabouts, 5.15 or 5.2. Yeah.
So, I mean, in my previous example, let's say in March, RBI takes the repo to 5.5 directly. So this 30 basis point movement in the repo rate will have some impact on the 6.6 yielding bond also, because now the differential between the rates that was available when this bond was bought versus what its rate is now, will make the prices go down.
Correct. So that's basically it. Let's talk about the net of tax returns. Now that's an interesting fact that we have to talk about, because this is where people are saying that it's a superior product to a fixed deposit. There is capital gains that arise out of holding this bond for 3 years. That's the minimum maturity that you're holding it. If you hold it for more than 3 years, there are capital gains benefits in that. There is indexation benefit available.
That's right.
Can we talk about that a little bit?
Sure. So I think let me start it this way. A fixed deposit, whether with a bank or whether with a company, no matter how long is its holding period, the taxation always remains the same, that the growth is taxed as interest and which is added to your incomes and gets taxed as per the slab rates.
So very simply, if I've got a fixed deposit of 1 lakh rupees, and if it's attracting an interest of 8%, if I've gained therefore 8,000 rupees in a year, that 8,000 rupees goes and sits on top of my earnings for the year from my salary, say.
Right.
So if I've been lucky and I've earned 15 lakh rupees in a year, net of everything else, that 8,000 rupees goes and sits on top of the 15 lakh rupees.
That's right.
So effectively, because that 8,000 rupees is in the highest tax slab, that 8,000 rupees gets taxed at 30%.
That's right.
Okay. All right. So that's how fixed deposits work.
So now vis-a-vis this, when we come to talking about the taxation for the Bharat Bond ETF, after 3 years, this gets classified as a long-term capital asset. What it implies for investors is that long-term capital assets, when you sell, will get taxed at 20%. But after you index the cost.
Okay.
Now, indexation is basically
accounting for inflation.
A tool that is made available under the income tax to account for inflation during the period of holding.
Right.
Here, since we are talking about the 3-year variant being maturing in 3 year and a certain number of months, practically the investor gets to inflate his cost over 4 financial years.
That's actually a benefit that's being offered in this particular Bharat Bond ETF.
In fact, we can also mention here that some of the experienced investors amongst our listeners can correlate this to FMPs or the fixed maturity plans that used to get launched specifically as a 3-year and a 3-day FMP, because merely by adding those 3 days, they were offering the investors 4 years indexation.
Okay.
So it's virtually the same benefit that we are talking about for the ETF as well.
Okay. Just to make it clear, have you done a calculation as to what the net of tax return on a 3-year paper or a 3-year ETF investment would look like, assuming, say, an inflation of 4%?
So let me answer this in this fashion, that in the past, when we have done similar exercises for even debt funds, virtually we have seen that the capital gain tax comes anywhere in the range of 5% to 8% of the growth. So as compared to a highest possible rate of 30% on the fixed deposit interest, an indexed fund actually helps in reducing the taxation to as low as, say, 8% of the gain. So that's a huge saving.
Yes.
Although the law says 20%, but it virtually will come down to 8% on the gains.
Because of the indexation. Okay, now let's talk about the 3-year versus 10-year. I would think that if you want to have the interest rate risk and when I say interest rate risk, it's also implying the possibility of higher returns, because in a situation where interest rates fall in the system and you're holding a Bharat ETF, bond ETF that you bought right now, and from this point interest rates fall, then you have the advantage of possibly higher returns.
Right.
So in that sense, would you say that somebody who wants to play that should hold a longer maturity paper or ETF?
Yes, because like we said, the indicated yield is around 7.5%. So in the same example, a 10-year ETF is actually going to give me 11 years indexation.
Yes.
So it is suitable from the taxation perspective as well. So somebody who's comfortable with a 7% yield over the next 10 years and feels that interest rates are only set to go down from here should take advantage of this and lock himself or herself at a 7% at least over the next 10 years.
But, having said that, we've looked at several cycles in the Indian economy, and it's not a given, right, that interest rates will stay pat or lower than they are right now.
It is, but there are quite a few investors who are better off in locking away uncertainty. Now, although there is a probability that rates will go up from here, there is an equal probability that rates consolidate here and they don't go, because we definitely know about nations who have been at zero interest rates or negative interest rates for a long time.
Yeah.
And as compared to that, even today in India, FDs are still yielding 7%. So there's a wide margin to reach zero. So there's a very strong opinion that in the coming years, the interest rates in India, if we have to march closer to being a developed economy, would only keep going down. So for that, a 10-year giving you 7% looks very attractive.
I want to also understand something that a lot of people have spoken about, and I'm sure our listeners to a certain extent have also heard about this. One of the factors that might prove a hindrance for this Bharat Bond ETF is the liquidity. Because though the cost of acquisition seemingly, or the cost of operating this, and we're talking about it in the form of an expense ratio, is extremely low,
right,
you could possibly be paying a significant amount of money if liquidity isn't there. Is that something that you think could prove to be a barrier?
As long as I'm holding it till maturity,
there's
the liquidity should not be an issue for me.
But if I'm buying and selling?
There could be bouts in which I may face this liquidity issue. So I may have to wait out for it to get sorted.
And just to explain this, it's the fact that there are not enough buyers and sellers in the market for this product. And in this situation, what happens is a market maker gets assigned.
Correct.
That is a large institution holding a significant number of these units.
That's right.
And with the ability to purchase these units. But what happens is that they take their cut, and therefore you're paying more, or you're essentially getting less for your Bharat Bond ETF purchase.
Which typically should be categorized as the transaction cost.
Exactly. So unless there is a significant amount of liquidity, you might have to shell out a little bit more when you're buying these.
Right.
All right. So just to close out this conversation, Arvind, I want to understand what type of investor, according to you, would benefit the most from holding this Bharat Bond ETF, and where do you think it should sit in somebody's portfolio?
In my view, this ETF will be best suited for people who are looking to park that portion of the portfolio which they are wanting to kind of conserve or be in a very risk-less portfolio, and where they're looking for it to be available to them after 3 years or maybe after 10 years.
Yes.
Today, among the other options available, one product that ticks off all the 3 boxes, which is where you know the maturities within 3 years, where you know the indicative returns, and third, where there is the risk of the lowest priority. Bharat Bond ticks all these 3 boxes, and that's why I think this fits well into these investors. Talking about how much should be parked here is, I think, a call every investor will need to take based on how much is the amount they're actually trying to park in the conservative category for now.
So in certain situations, say for example, if you know exactly how much money you will need 10 years from now, say young parents who have children who, they'll have to provide for in terms of higher education, to conserve the amount of principal that they're setting aside, perhaps they can consider doing this.
Why not? Yes.
And in another situation, say somebody who's retiring, how should they approach it?
Yes, because just before retirement, there always has to be a consolidation phase, as we call it. So somebody who has managed to accumulate a decent sum and are 10 years away from their retirement can consider this. Or even someone who is like around 3 or 4 years away may still want to park a substantial amount here to ensure that this kitty becomes available to them at the end of those 3 years.
In fact, I think if somebody is getting a certain amount of money at the end of their tenure, and if they don't need that money immediately for the next 8-10 years, they can also consider it, say?
Why not?
Yeah, okay. So there are various use cases for this. I've heard, I just want to ask you, because are there any options apart from the ETF that you can talk about? I've heard a few people being a bit critical of the ETF, saying if you want to take exposure to, a bond fund or basically a bond ETF, you might as well buy the bonds directly. And there are public issues to purchase, but they're not like-to-like comparison, are they?
They may be a like-to-like comparison, because if there are PSU issues, it would be a similar one. But I think what stands out here, one is there are very few public issues coming for PSU companies, one. And number two, here, since it's not one company, but 12 of them.
Yeah.
So you
concentration risk is not there.
The diversification is inbuilt into this system. Which also reminds me maybe to add one more concluding point here. As we mentioned right at the start, that this ETF, all you require is a demat account. For those investors who are not comfortable to get into a demat account and invest, I think the AMC also is planning to have a variant called as the fund of fund variant.
Oh yeah, how does that work?
So it will be very similar to a mutual fund, that you buy units of that fund, which will act as the feeder fund, and in turn they buy the ETFs.
Okay, fair enough.
So it is similar to any other mutual funds that you hold. So investors have this option as well. Okay,
that's good to know. I think that more or less covers the topic of the Bharat Bond ETFs. There are use cases, as you mentioned, and the features, especially with regard to the taxation and the indexation benefits therein, make it a superior product in a sense to fixed deposits.
Right.
I hope that this conversation helped you out if you're thinking of subscribing to the Bharat Bond ETF issue. Do let us know what you think in the comment section. And if you have any questions, I'll be more than happy to share them with Arvind, and I'm sure that he'll get in touch and answer all of them. This was BQ Big Decisions, and you were listening to BloombergQuint.
If you enjoyed Big Decisions, check out some other podcasts on the IVM Podcast Network. You can check out Paisa Vaisa, hosted by Anupam Gupta, Advertising is Dead, hosted by Varun Dugirala, the Ronnie Screwwala podcast, hosted by Ronnie Screwwala, or Cyrus Says, hosted by Cyrus Procha. These shows are available on the IVM Podcast website, app, or wherever you get your podcasts from.
Hi, my name is Anupam Gupta. I'm B50 on Twitter. I am the host of Paisa Vaisa, the show that talks money. On my show, I speak to experts from every field of money and finance, from stock markets, equities, debt funds, credit cards, life insurance, every possible area of money and finance that you can think of. We even did an episode on cryptocurrency. I've got fantastic guests from mutual funds to personal finance experts everywhere. Robo-advisory, startups, just name it, we've got it. At Paisa Vaisa, we help you make smart decisions about money. You work hard for money. Now make your money work hard for you. New episodes out every Monday, and you can listen to my show on the IVM Podcast app or any other podcasting app that you have.
Do you have a night routine? Well, everyone has one. And the to-do list usually looks like this. Brush your teeth, set that alarm, get into your pajamas, and switch off those screens. But here's one more to add to that list. Tune into the Positively Unlimited podcast for a dose of positive action and tips on how to build powerful mindsets. Episodes out every Monday on the IVM Podcast app, ivmpodcast.com, or wherever you tune into podcasts.